Hello and welcome to the September 2022 monthly video series. My name is Mike Horwath. I am the Chief Investment Officer here at Diversified. What we do every month is we just pick a topic, an asset class, usually try to be very relevant in markets and try to explain what's going on, why are things happening, or why is it relevant today. So really what I wanted to talk about today is the labor market conundrum and the position that the Federal Reserve has put themselves in at this point. So I want to kind of rewind back to February 2022 when we did this same video series. We had spoken about the Federal Reserve at the time. So if you remember this graphic, really just illustrating what the role of the Federal Reserve is. The key here is to know that they have really a dual mandate. The Federal Reserve's job is to really remain impartial to political pressures and to try to keep the economy and markets stable. They do that through a few different mechanisms, but one of the biggest things that they look to do is manipulate short-term interest rates. So they will manipulate short-term rates in an effort to balance two things. One being full employment, or said another way, low unemployment. And on the other hand, to keep prices stable and positive, right? So low positive inflation. So the Fed's job is to do these two things, right? So keep prices stable and to keep unemployment low. And they will manipulate short-term rates, right? Either raising or dropping short-term rates to either stimulate the economy or to kind of restrict the economy in times when markets get a little bit too hot, for example. So obviously today, it's no surprise that inflation is running hot and unemployment is very low. So what the Fed is staring at now is trying to get inflation down while not doing too much damage to the labor market. So what is really the problem with the labor market, right? It doesn't sound like there's a problem. And that's really where our conversation needs to go is what does the strong labor market do to the other side of the coin, to the inflation side? So first, let's look at what employment looks like today. And you can see that non-farm payrolls have been steadily increasing since the trough of the pandemic, back to pretty much pre-pandemic levels. And the bottom graphic will show the unemployment rate, which most people are familiar with, dropping and getting all the way down to about 3.5%, sitting around 3.6, 3.7 today. Anything under 4% is a very strong employment number. And the fact that we see unemployment around 3.7% presents that the labor market is very tight, very strong, and we've seen wage growth pretty strong as well. So employers need labor. There aren't a ton of workers out there. This has been a problem, and it's also a problem for the inflationary conversation as well. So let's talk a little bit about that. So let's stick to core inflation, because that is the natural challenge right now, is getting core inflation down. So you can see that core inflation, whether you measure it by CPI, so the Consumer Price Index, or the Personal Consumption Expenditures Index, both are showing a clear trajectory upwards, and they've remained elevated. So what does that mean though? What's the problem there? And what we see is that when you peel the onion back, sticky inflation is the challenge. So this is a good graphic that shows sticky inflation versus more flexible inflation. So when we say headline inflation, or we'll talk about the flexible parts of the market, that's really the commodity side, that's the food side, that's automobiles, things like that. Those are a little bit more volatile, they ebb and flow. A lot of times what you'll look at is, what does the CPI or the inflationary environment look like if we strip those volatile areas out, right? A lot of times commodities are purely driven by supply and demand. Sometimes like an exogenous event like what happened or is happening in Ukraine can cause those prices to rise. It has less to do with the overall economy, more to do with supply and demand of a certain commodity. But when we talk about sticky inflation, right, the sticky goods and services keeping core inflation up, the problem is that you're seeing things like education, things like healthcare services, stuff like that, that are the sticky part, that are the core components of inflation, are remaining elevated. They're not coming down. And the labor market's a big part of that. The challenge becomes, how does the Fed get inflation down when the labor market is so strong, people are working, and people are clearly still willing to spend money? So that is entirely what they're doing now, right? They are raising rates to try to slow the economy, and they have been very forthcoming that they expect unemployment to increase. It will need to increase. As that happens, they expect consumer spending to slow, and that inflation will slowly, at least the sticky parts of inflation will slowly continue to come down. It's a painful process. There's a lot of people, when you get inflation like this and it's been so persistent and it's deep into these sticky areas, it takes some pressure from the Federal Reserve to slow things down to try to reverse that course. The good news is that we're starting to see signs that this has already begun to reverse. So first, we've talked over and over again about the strength of the consumer. So coming into this year, the consumer has been as strong as it's ever been. Household balance sheets, household assets, a strong labor market, all of these components, consumer spending naturally, very, very strong. Consumer spending is 70% of US GDP, very, very important to the health and sustainability of our economy. What we're seeing, though, is this trajectory downward of saving rates here in the US, which really typically will mean that people are spending more or able to save less. So we've had all this excess savings built up from the stimulus of the COVID situation. And now we're starting to see those savings rates and things like that start to pull back. That will likely be helpful to the inflationary conversation. On the headline side, we're also seeing commodity prices ease. Oil at one point was above 100, now down, you're seeing in the 70s. It had dropped down into the 80s not too long ago, into the 70s. Part of this is a natural concern of demand going to weaken, but those commodity pressures weakening will help both the core and at least we'll pull back on the headline inflation side, which is the one that includes both energy and food prices. When we look long term, I think that's the important part. Inflation in today's world is priced to be a short-term event. So the top chart here will show you what expectations are for the market for 1 year ahead inflation. You can see it's still elevated at 5.75%. The market expects that it's going to take time, and this aligns with the Fed saying, with what the economists that we speak to believe in, that inflation is going to come down. It's just going to take time. It is going to take time into 2023 for that to happen. So it's no surprise that a year from now, markets still expect inflation to remain elevated. But the bottom chart shows where markets expect 5-year inflation to be 5 years from now. So if you think about a 10-year period, this is what markets expect from years 5 through 10 over the next 10 years. It expects it back down around 2.3-ish%. So markets fully expect, while it may be above the Fed's target slightly, 2.3% is a very sustainable number. I think the Fed would tell you that. I think they'll be flexible enough to not push markets to try to get back down below 2, for example. Markets believe in the long term, or at least even in the intermediate term, that inflation is not a huge problem. However, in the short term, it continues to be. This is the challenge that the Fed has presented themselves with. It is getting the labor market to cool off, to get those sticky parts of inflation to cool off, and to do so in a way that doesn't damage the economy too much. That's why you see a lot of people talking about this. The Fed need to pause. They're raising rates very quickly. We have to wait to see what the effects of those rate increases are. And the natural concern that markets are going to have is if they go too fast, they may overdo it. And then the market obviously would then go into a recessionary environment, and then we have to go into a recovery period where they likely have to then start to lower rates. It's a very tight walk that they're trying to walk right now, but that is the conundrum that they've put themselves in. To really summarize it, commodity prices are easing. So we're seeing headline inflation coming down because of that. It's the sticky prices that are remaining elevated, and a lot of it's driven by a very strong labor market where people are willing to spend, people are working. Until that cools to some extent, it is hard to see that consumer spending will slow too much. We are seeing some signs that it's happening, but we're going to have to see more, and the Fed's going to require that they see more of that softening of that kind of economic data in order to slow the pace of their interest rate increases. We do believe that they are getting to the tail end of what they believe they will need to do, but we're going to have to see that over the next month, 2, 3 months, that the monthly inflation figures start to come down. So this is what the markets are grappling with. I hope this was a clear explanation of what we're looking at internally, and we're adjusting portfolios accordingly along the way, and we're trying to remain flexible as always. But I hope this gives a good perspective of what we're seeing, what the challenges that the Fed faces are, and the different forces that are going to drive the economy and really markets moving forward. So we'll be coming out shortly with our quarterly investment review webinar here in early October. I'll also have a newsletter coming out that I'll go through a couple different factors tied back to what we just went through. But for now, my name is Mike Horwath, and for everybody here at Diversified, thanks for the trust you put in our team. Take care.